In 1929, stocks crashed 89%, but bonds held their value. In 2008, real estate fell 55%, but treasury bonds rallied 43%. Every major crash in history destroyed one or two asset classes while others provided refuge. Until they don't. Understanding why crashes historically contain themselves reveals something critical about the environment we're in today. For the first time since reliable financial records began, every major asset class is trading above historical valuation averages simultaneously. Stocks, bonds, real estate, private equity. The pattern that prevented total collapse in every previous crisis has disappeared. And the conditions that created this situation took 14 years to build. This is Economic Pattern Vault, where we break down financial history to understand how markets actually work by studying how they fail. Each video uncovers the repeating patterns behind economic booms, debt cycles, and power shifts so you can see what's happening beneath the headlines. If you find this breakdown useful, like the video, subscribe to the channel, and share your thoughts or questions in the comments. The 1929 crash is remembered for stock market devastation. The Dow Jones fell from 381 to 41 over 3 years, an 89% decline that wiped out fortunes and became the defining image of the Great Depression. But here's what often gets overlooked. Only 2.5% of Americans owned stocks in 1929. The crash devastated the wealthy, but it didn't directly destroy middle-class savings because most Americans had no exposure to equities. More importantly, while stocks collapsed, government bonds held their value. Investors who recognized the danger early and shifted to treasuries preserved their wealth. Total debt in 1929 was 190% of GDP, significant but manageable compared to what came later. Jump forward to 2008. This was a real estate and credit crisis. Housing prices fell 33% nationally, with some markets like Las Vegas and Phoenix seeing 55% declines. The stock market dropped 57% from peak to trough. Banks collapsed. Credit markets froze. It felt like the end of the financial world. But again, containment. U.S. Treasury bonds rallied 43% during 2008 as investors fled to safety. Gold rose. The classic diversification strategy worked. A 60-40 portfolio of stocks and bonds lost money, but not catastrophically. The Federal Reserve had ammunition, cutting interest rates from 5.25% to zero, and printing $4.5 trillion. The government passed $800 billion in stimulus. These interventions prevented total systemic collapse. In both crashes, the pattern was identical. Destruction in one or two asset classes, preservation in others. This wasn't luck. This was the mathematical reality of how bubbles form. Asset prices become detached from fundamentals in specific sectors while others remain reasonably valued. When the bubble bursts, capital flows to the undervalued assets, creating a floor that prevents complete wealth destruction. The wealthy who lost everything in 1929 made a specific mistake. They were 100% concentrated in stocks, often on margin. The middle-class families who lost homes in 2008 were overleveraged in a single asset. But investors with diversified holdings survived both crashes. This escape valve has existed in every crash in modern financial history. The South Sea bubble of 1720 destroyed equity investors, but left land values intact. The 1970s stagflation crushed bonds, but gold multiplied 10 times. The 2000 dot-com crash obliterated technology stocks, but left value stocks and real estate untouched. There was always somewhere to hide. The pattern insiders recognized in every historical crash was this: overvaluation clusters in specific sectors, not everywhere simultaneously. This happens because bubbles require a compelling narrative that attracts capital to one area. In the 1920s, the narrative was industrial transformation and stock market democracy. In the 2000s, it was the internet revolution. In 2008, it was the belief that housing prices never decline. These narratives are powerful, but they're also specific. They don't apply to every asset class at once. And when reality contradicts the narrative, capital doesn't disappear. It relocates to assets that weren't part of the bubble story. This capital migration creates the floor that prevents total collapse. Sophisticated investors didn't need perfect timing to survive crashes. They needed to recognize when one sector had detached from fundamentals and maintained positions in assets the bubble narrative had ignored. In 1929, anyone holding government bonds survived. In 2008, anyone who hadn't over-leveraged into real estate maintained their wealth. The mechanism is behavioral. Bubbles require universal belief in a specific story. But universal belief in everything simultaneously is psychologically impossible. Markets need a villain to justify the hero in bull markets. That villain is usually cash, bonds, or gold, boring assets that don't participate in the exciting narrative. These unloved assets become the refuge when the narrative breaks. Today's environment differs from historical patterns in a specific way. There is no obvious refuge asset. The Shiller-Cape ratio for stocks stands at 39, more than double the historical average of 17. That's higher than any point except the 1999 peak. But bonds aren't offering refuge. Yields were suppressed for over a decade through central bank purchases, pushing bond prices to historically elevated levels. When yields rise, existing bonds lose value. Real estate prices rose 47% from 2020 levels while mortgage rates tripled from 2.7% to 6.8%. The median home price of $425,000 requires the same monthly payment at current rates that $280,000 required in 2020. Private equity valuations are at record levels. Even cryptocurrency, which some view as an alternative to the traditional system, correlates closely with tech stocks and follows the same liquidity-driven pattern. This didn't happen by accident. 14 years of near-zero interest rates and approximately $16 trillion in central bank money creation inflated every asset class simultaneously. When the cost of borrowing approaches zero, the present value calculation that determines asset prices increases across the board. Cheap money lifts all boats. The total debt load amplifies this dynamic. U.S. debt to GDP now stands at roughly 140%, compared to 350% in 2008 and 190% in 1929. This limits the government's ability to respond to a crisis without triggering concerns about currency stability. Additionally, 58% of Americans now own stocks, compared to 2.5% in 1929. The pain from any correction is no longer confined to the wealthy. It's universal. The clearest insight from studying historical crashes is this: survival doesn't require predicting the exact timing of a collapse. It requires recognizing when the traditional escape mechanisms have been compromised. In every previous crash, diversification worked because overvaluation was concentrated. Today, diversification across traditional assets means spreading risk across multiple overvalued categories. The pattern isn't about whether a correction will happen. Markets always eventually revert to historical valuation averages. The pattern is about recognizing when the standard playbook for protection doesn't apply. Understanding this distinction is what separated those who preserved wealth in past crashes from those who didn't. The simultaneous overvaluation pattern we see today required extraordinary conditions to create. A decade and a half of emergency monetary policy applied long after the emergency ended. These conditions don't appear frequently in history, which is precisely why the current environment deserves attention. Not panic, but attention. The crashes of 1929 and 2008 taught investors that diversification protects wealth. But that lesson assumes diversification across differently valued assets. When everything moves together on the way up, it's worth understanding how closely they might move together on the way down. History doesn't repeat itself exactly, but financial behavior does. If this breakdown helped you see the pattern more clearly, like the video, subscribe to Economic Pattern Vault and share your perspective in the comments. Understanding the cycle is how you stay ahead of it.